Welcome to Talk Tickers, your go-to for getting right to the heart of earnings calls.
Glad to be here.
Today, we're diving into Cognex's Q2 2025 call. Lots happening there, some really significant improvements, wouldn't you say? And a pretty compelling vision for the future.
Absolutely. It's crucial, especially in fast-moving markets like industrial automation, to look past just the top line, to really understand what's driving the performance.
Totally agree. So let's jump right in. The headline numbers, very encouraging. Cognex really beat expectations this quarter.
They certainly did.
Okay, so key figures. GAAP EPS hit $0.24. That's up 15% year over year.
A solid increase.
And non-GAAP EPS was $0.25, which edged out the consensus estimate of about $0.24.
Right, a nice little beat there.
Revenue came in at $249 million, also a beat against around $246 million expected. And importantly, that's up 4% year over year.
And you mentioned consistency before we started. This is actually their fourth straight quarter of organic growth.
Exactly. That's the pattern that really stands out.
Yeah, and I think that pattern, especially the margin story and the cash flow, is what really got the market's attention. It signals confidence.
Let's talk about those margins and cash flow because, wow, adjusted EBITDA reached 20.7%. That's $52 million.
Mm-hmm. First time over 20% since Q2 of 23, right?
That's it. A big milestone. Operating margin expanded nicely, too, up to 17.4%. That's 130 basis points higher year over year.
And the adjusted operating margin wasn't far behind.
Nope, 18.7%, up 90 basis points. Then there's free cash flow, just surged.
Yeah, what was the number?
Up 74% year over year to $40 million.
Incredible.
And the balance sheet looks fantastic, $553 million in cash and investments, and crucially, no debt.
Zero debt. That combination, expanding margins, strong cash generation, no debt, that's a powerful signal to investors about the health of the business. Gives them tons of options.
And they're returning value, too. Declared in a 0.08 cents per share dividend.
Standard practice for them, but good to see.
And over the last year, they've returned over $200 million to shareholders. That's actually more than 110% of their free cash flow.
Shows real commitment there.
Okay, so we've got these great numbers. Let's unpack this. What's really driving it? How did they grow revenue and cut costs at the same time?
Right, because adjusted operating expenses were down 2% year over year.
Or 3% on a constant currency basis.
Exactly. And this wasn't accidental. It was clearly a very deliberate company-wide program. Engineering, sales, back office, facilities, they tightened belts across the board.
So disciplined cost management was a key lever.
Absolutely. It's not just about cutting, though. It's about profitable growth. And what's fascinating here is how this ties into the new CEO, Matt Mazners' strategy he laid out at Investor Day.
Yes, the key objectives.
Right. 3 big ones. 1, be the #1 provider of AI tech for industrial machine vision. That's a bold goal.
Very.
2, deliver the best customer experience, thinking seamless engagement, direct sales, a unified product ecosystem, better global support.
Makes sense.
And the 3rd?
Ambition squared. Double the customer base.
Yeah.
Really scale up that go-to-market engine. Doubling the customer base. Wow, and you can already see hints of this strategy working in the numbers.
You can. And speaking of that AI leadership goal, let's talk OneVision.
Yes. Their new cloud platform for AI-powered machine vision. What exactly is it? Why the buzz?
Well, think of OneVision as the bridge-making sophisticated AI, much easier to use in factories. It simplifies how you create, train, and scale these AI vision tools.
So making AI more accessible.
Precisely. It tackles that complexity barrier. They gave this great example, Paolo, a Korean noodle maker.
Okay.
They used OneVision for inspecting packaging seals. The result, significantly fewer false rejects. It perfectly shows how OneVision connects, edge to deep learning, bringing powerful AI right to the factory floor equipment. Much more efficient.
That makes it very tangible, practical AI on the factory floor. So we see the strategy, we see the tech. How is it playing out across their different markets? Where are they winning? Where are the challenges?
It's definitely a mixed bag, which tells you a lot about the current industrial climate.
Okay, let's start with the good news. Logistics.
Double-digit growth year over year. That's their 6th quarter of growth in a row there.
6th. And it's not just the big e-commerce guys anymore.
No, it's broader penetration. It seems to be coming from both new capacity builds and also process improvements in existing sites using their 2D and 3D AI tools, really optimizing operations.
Okay, solid performance in logistics. What about broader factory automation, like consumer electronics and packaging?
Consumer electronics saw revenue up year over year. Pretty broad strength there. And interestingly, some signs of supply chain shifts out of China helping them.
Yeah, that diversification trend.
Yeah. And packaging, also positive. Mid-single-digit growth year over year. Seems like healthcare med devices, pharma, life sciences was a big driver, plus fast-moving consumer goods. They credited their salesforce transformation there too.
So that focus on customer experience and go-to-market is paying off.
It seems so. And geographically, it paints a similar picture of shifts. Europe was up 13% constant currency.
That sounds huge.
It does. But they flagged that a lot of that was due to changes in where orders were booked. Underlying growth was slight, led by packaging.
Got it. Americas.
Up 8%, driven by logistics and packaging strength.
And Asia.
Other Asia, so excluding China, was up 5%. That's where you see those consumer electronics supply chain shifts benefiting them. Greater China, though, was down 18%.
Ouch.
Yeah, though if you exclude some procurement timing changes, it was more like a modest decline. Still reflects those supply chain realignments, though. Manufacturing is definitely moving around.
That global flux is clear. Now, the tough spot, automotive, still challenged.
Yeah, it remains the most challenged vertical. Continued year-over-year decline, really due to those macro headwinds we keep hearing about.
But the underlying need for vision systems hasn't gone away, right? Cost pressures, quality, labor shortages.
Exactly. Those fundamental drivers are still strong. Even in auto, manufacturers need this tech. And Cognex is active in areas like EV battery applications. That market's normalizing a bit after some overcapacity, but the long-term potential is still definitely there.
Okay. And lastly, the semiconductor market.
Modest decline year over year there. That fits with their cautious outlook for the full year, citing trade policy and tariffs creating uncertainty.
Understandable.
But long-term, the demand for advanced AI chips, high bandwidth memory, that's not going away.
Yeah.
And their Mortex acquisition seems to be helping strengthen relationships, especially in Asia.
Right. Okay, so the strong Q2 overall, despite some pockets of weakness. The big question then is always, what's next? Let's look at the Q3 outlook. Management sounds confident.
Yeah, the guidance certainly reflects confidence. They're projecting Q3 revenue between $245 and $265 million.
Okay.
At the midpoint, that's about 9% year-over-year growth. Pretty healthy.
And margins.
Adjusted EBITDA margin guidance is 19.5% to 22.5%. The midpoint there implies around 340 basis points of year-over-year expansion.
Wow, 3.4 percentage points. That's significant.
It is. And adjusted EPS is expected between $0.24 and $0.29. Again, the midpoint suggests roughly 35% year-over-year growth.
Very strong guidance. Now, what about those wider economic factors? Tariffs, trade wars, always a hot topic.
It always raises questions, doesn't it? Cognex actually said they expect no material impact on adjusted EPS or EBITDA margin from tariffs in 2025.
Really, no material impact.
That's what they stated. They do anticipate maybe a 50 basis point hit to gross margin, but they're actively working on supply chain mitigation for that.
Okay.
And interestingly, they actually see potential long-term tailwinds from this uncertainty as customers look more towards automation to handle costs and diversify supply chains. Plays right into their wheelhouse.
That's an interesting take. Now, there was a special item mentioned for Q3 revenue, right?
Yeah.
Something about medical lab automation.
Yeah, a one-time commercial partnership.
Yep.
Expected to add maybe $8 to $14 million in Q3 revenue.
But they excluded it from the formal guidance. Why?
Good question. They basically said it's a strategic resource allocation in a market they consider subscale for them right now, meaning it's not core or big enough for them to focus sustained investment on. So by excluding it, they're trying to give you a cleaner view of the underlying performance of their main business, separate from this one-off deal.
That makes sense. And they also mentioned Q4 seasonality.
Right. Expect a return to more typical patterns, which usually means a high single-digit sequential step down from Q3. Standard stuff.
Got it. And what about that One Big Beautiful Bill Act, OBBA? Any impact?
Yes, the OBBA. They expect it to be neutral to adjusted EPS this year and insignificant after that.
But there's a cash impact.
There is. A nice one. A $12 to $15 million cash tax benefit in 2025. It phases out over 5 years, but still it's a nice boost to their cash position.
Definitely helpful. Okay, last piece on strategy, M&A. Are they on the hunt?
They have a high bar, very focused on strategic fit, value creation. Mortex was a good example of a larger deal they felt met that bar.
So not just buying for growth's sake.
No, they are targeting maybe 3% plus annualized growth from M&A over time, but they emphasize they're not in deal mode. Very disciplined. They're even looking at non-vision adjacencies, but only if the right opportunity comes along.
So patient and strategic. It feels like Q2 was a solid step towards their longer-term goals, right? That 2026 target of over 20% adjusted EBITDA margin?
Definitely. And aspirations for 25-30% beyond that. It's clearly a multi-year plan to build a higher quality, more resilient automation platform.
Okay. Now, as you know, here on Talk Tickers, we love to end with a bit of a provocative thought. Just remember, everyone, this is purely for discussion entertainment, absolutely not financial advice.
Right. Purely conceptual. So picture this for a moment.
I'm picturing...
Go on Cognex. But not just as the industrial vision leader we know. Think of it as an emerging industrial AI platform company.
Okay, interesting angle.
The market arguably still values it mostly on those traditional hardware metrics. But you look at the early signs from OneVision, you look at that $553 million cash, zero debt, and you look at Mazners' clear plan for AI leadership and disciplined M&A, potentially even outside core vision. There's a case for a significant re-rating potential down the line.
So betting on multiple expansion.
Exactly. Driven by that pivot to higher margin software, analytics.ai. You can even think about a long-short trade against a more traditional hardware-focused industrial peer, maybe one without such a clear software or AI story.
Okay, what's the outrageous part?
The outrageous part is banking on like a sauce-type multiple for a company whose big AI platform story is still rolling out, methodically. It's not fully proven at scale yet. But the fundamentals, the balance sheet, the strategy, the optionality, they look really compelling for a multi-year view. Too compelling to ignore, maybe.
That is definitely provocative, betting on the AI platform pivot before it's fully reflected in the valuation. Lots to think about there.
Food for thought.
So to wrap it up, Cognex's Q2 showed strong execution, clear strategic direction under new leadership, and some really exciting innovation with OneVision. Signs point towards a leaner, smarter, more AI-focused future.
And really understanding these details, seeing these potential inflection points.
Yeah.
That's often where the insights lie for investors navigating these markets.
Couldn't agree more. And one last time, everything we discussed today is for informational purposes only. It is not financial advice. Please always do your own research.
Absolutely.
Thank you so much for joining us on Talk Tickers for this deep dive into Cognex.
My pleasure.
We hope you feel better informed. Tune in next time for more insights from the earnings calls shaping tomorrow's market.